I have already completed the profits priority incorporation, and now I am going for valuation of shares and valuation of goodwill. Okay, valuation of shares. Every share of a joint stock company, it will have one value, and that value will call that thing as face value or par value. But one thing you have to remember is that every share will have two values, whether it is a new company or whether it is an existing company. When you go for a new company, issue value and face value, these are the two values that we come across. Issue value, sometimes it will be more than the face value. So that difference we have to take that as share premium. Sometimes the issue value it will be less than the face value. So we have to take that as discount on issue of shares. These are the two things that we come across for a existing and for a newly company, for a newly established company. Generally, people will give much preference for face value or par value. And rare circumstances only they will give importance for the issue value. When the issue value it is more, it is nothing but a premium, already I told you. And when the issue value, when it is less than the par value, it is nothing but discount. This is for a newly established company, for a newly upcoming company. When you go for already established companies, there also you will have two values. One is face value, that is par value, and one is market value. And this market value again it will have two types, purchase value and sale value. Okay, when you want to purchase, you have to go for a purchase value, and when you want to sell, you have to go for a sale value. Like that, every share will have two values. Now, coming to the established companies, the shareholders and the board of directors, okay, sometimes they want to see how the shares are in the market, that is, in stock exchanges, how they are. So, for that, they have to go for market value. And estimation of that market value is nothing but valuation of shares. Valuation of shares you have to do regularly at regular intervals. That is once in a year or once in 6 months, like that, people they will go for that. So that it is nothing but the market value. So if you take a company, for example, PQR company, and if the face value of that company is 10 rupees, this PQR company directors as well as the board of directors as well as the managing director, all the other people, they'll think that what is the value that it is having in the market. Our face value is 10 rupees, but it may be 10 rupees or it may be below that or it may be above that. So in order to know the market value, they'll go for valuation of shares and they'll see what is the value of share. When you go for estimation or when you go for knowing of this market value, sometimes the market value it will be less and sometimes it will be more than the face value. And this thing you will come across, and if you value that share, if you see that in the market, okay, then you will come to know. And there are so many factors hidden, okay, in valuation of shares. For example, the production activity, what is the productivity, what is the production activity, what is the sales, what are the purchases, how the accounts are maintained, and what is the size of the company, what is the location of the company, whether it is nearer to the raw materials or whether it is far away from the raw materials, transportation facilities, that is raw materials transportation as well as finished goods transportation, whether it is nearer to the market or not, everything, every aspect we have to take into account in valuation of shares. And most importantly, they'll go for the profitability of the company, whether the company is running under profit or under loss. And if it is earning profit, how it is, what is the profit amount, that is EPS, earnings per share. They have to take into account earnings per share. Okay, DPS, dividends per share. All these things, the borrowings from the banks, borrowings from the financial institutions, all these things they will take into account, and then only they can able to calculate the share value. That is, all these factors they will have their influence on this valuation of shares. So valuation of shares is not an easy task, and it is not an easy process. We have to consider so many things for valuation of shares. Okay, when you want to value the shares, when you want to value the shares, how many methods are there for valuation of share? Okay, there are three methods. There are three methods. Net assets method, or assets backing method, or intrinsic value method. Like that, one method is there. Next, earnings capacity method, or yield method, or market value method is the second method. And the third method is fair value method. Okay, fair value method. Like that, there are three methods for calculation of a share of a company. I'm talking about the public limited companies only. I'm not talking about the private limited companies. I'm talking about the public limited companies, please. Mind it. Okay. When you go for assets method, or assets backing method, or intrinsic value method, okay, how we can find out the value of a share in the market? For that, we have to take into account the assets, total assets of the company. And from the total assets, we have to deduct the outside liabilities. That is, how much we have to pay to debenture holders, what are the sundry creditors, what are the bills payable, whether we have taken any bank overdraft, all these things, outside liabilities. All these are nothing but the outside liabilities. These outside liabilities have to be deducted. Then we will come across the net assets. Okay, net assets. It is also known as net worth. Okay, from the net assets, we have to deduct the preference share capital along with the dividends accrued on it, on the on those shares. So preference capital and dividends accrued on those shares we have to deduct, and then we will come across amount available to equity shareholders. Here, one thing you have to keep in mind is one thing here you have to keep in mind is you will come across two types of shares. All of them they know about it. Preference shares and equity shares. Preference shares are those shares which are given first preference either in receipt or in payment. So preference shareholders, whomever they are purchasing preference shares, okay, preference shareholders, they are visiting like visiting professors. They will come and they will go away as and when they want. But the actual owners of a company are the equity shareholders. So that's why amount available to equity shareholders divided by number of equity shares. When you do this, automatically you will come to know the value of a share. Automatically you will come to know about the value of the shares. Sir, suppose if shares are given some values, that is agreed values, then you have to take those things. Suppose if agreed values are not given, you have to take the book values of the assets and you have to total them. You have to get the total assets. From the total assets, you have to deduct outside liabilities. Okay, you will come across net assets, and from the net assets, you have to deduct the preference share capital along with the dividends. Then you will come across amount available to equity shareholders. That thing you have to divide with number of equity shares. Then you will derive the value of shares. Here also, you will come across fully paid shares and partly paid shares. Okay, then also you have to take into account what are the amounts that are to be paid to the company we have to take, and these values we have to add, and we will call them as notional values, notional costs or notional values. These things you have to add, and then you have to make the partly paid shares into fully paid shares, and then you can find out the value of the share. Suppose if you come across the value of a share, whatever it may be, the unpaid amounts, if you deduct that, automatically you'll come to know about the value of partly paid shares. Okay, automatically you'll come to know. So this is how you will come across valuation of shares by net assets or assets backing or intrinsic value. Okay, now coming to the second method, that is earnings capacity method or yield method or market value method. Here you will come across two types, basing upon dividend and basing upon earnings. Basing upon dividend and basing upon earnings. And in most of the cases, you will come across the problems. Okay, you will come across the problems on earnings. What are the earnings of the company? How much the company is earning? All these things they are taken into account and they will decide about the share value. So for that, first of all, we have to find out expected rate of return. Expected rate of return, how you will come to know? Expected profits by equity share capital into 100. Expected rate of return you will always come in percentage only. How much rate of return that we are going to get? First of all, they have to look after that. And for that, you have to take into account the expected profits. What are the expected profits that we come across? Okay, expected profits are nothing but the average profits minus the normal profits. That thing you will come to know. This much amount we are going to get in this year, like that they will expect. So that expectation is nothing but expected profits of the company. So expected profits of the company divided by equity share capital. We are not taking into account preference share capital. Mind it, we are taking into account only the equity share capital into 100. So you will get expected rate of return. So after getting the expected rate of return, what is the normal rate of return that we are going to get? The people they will come for that. See, normal rate of return. Normally, how much the company people they are going to get the profits? That is nothing but normal profit. Okay, because one thing you have to keep in mind is every company when it starts, it won't get profits, as there is a proverb. Okay, anticipate no profits but be prepared for losses. That is the proverb in accountancy subject. When you go for first year, okay, when we are dealing with, okay, convention of consistency, convention of conservatism, there the proverb, they it will come. Expected no profits, but be prepared for losses. That is the slogan, that is the proverb that we come across. So every company, they won't get profits in the beginning stages, just normal profits to sustain them, to run the business. That type of profits they will come. So what they have to do is, what is the normal rate of return that they are going to get? They have to take that thing, and with that normal rate of return, we have to divide the expected rate of return. Okay, expected rate of return by normal rate of return into paid up share value. I told you already that face value or par value will be there. So that expected thing we have to take into, okay, paid up share value. So automatically you will come to know about the share value, okay, in the market. And that share value, sometimes it may be below the face value or above the face value. So in that way, you will come across the second method, that is nothing but market value method. Now, face value method, that is entirely different. Face value method, it will take into account, okay, value by net assets method, by value by market value method divided by 2. That is the fair value method for valuation of a share. That is, the previous two values it will take, and it will take the average of the total. So thereby they'll come to know about the fair value method. And this fair value method also, sometimes it will be more than the face value, and sometimes it may be less than the face value. But one thing you have to keep in mind is you cannot remove the face value or the par value fixed by the first directors of the company. Whatever it may be, the value that was fixed by the first directors, it should be accepted, and it must be accepted as face value or par value. Then only we can able to find out the market value. And in market value also, I told you already that you will come across purchase value and sale value. At what rate you can purchase the shares, at what rate you can sell the shares. If you want to sell, okay, at what rate you have to sell. If you want to purchase, at what rate you have to purchase. All these things you will come to know. And one more thing is, when you are going for valuation of shares, okay, the valuation of shares, you will come across in decimal points, like 9 rupees 60 paise, 9 rupees 4 paise, 9 rupees 35 paise, like that it will come. Okay, but it won't be in rounded figures, like how we come across in debentures. Debentures are to be calculated or to be taken in round figures, but whereas the shares, they should not be like that. You cannot take that in rounded figures. You must show them as it is. Okay, if it is 9 rupees 16 paise, it must be shown 9 rupees 16 paise. So that thing, it will show the entrepreneurs or the board of directors or the shareholders that the our share is in this way in the market. So what we have to do to make it go to the face value, they have to think and they have to decide what are the things that we have to change, what are the things that we have to develop. All these things, the board of directors and the shareholders, they will think. Then only the market value will come to the face value. But generally speaking, you will come across decimal points for a share value when you are going for valuation of a share. Okay, with this I am stopping, and next topic, that is valuation of goodwill, I'll start tomorrow in the next class. Okay, and if you like this explanation, please subscribe to my channel. And those people who want to take doubts and who want the subject, who cannot able to understand the subject, okay, you can ring up to me or you can send messages. Thereby I will try my level best. I'm not telling that I will solve completely. I'll try my level best to explain and tell you in the best manner you require. Okay, and my cell phone number is 9849238902. Please, okay, contact if you are having any doubts, and please subscribe to my channel. Thereby I'll feel happy that so many my lecture, whatever it may be, I'm not a great person, but I'm doing my level best, and I can able to solve. If I solve one student, if I can make one student to understand what I'm telling, I'll feel proud. I'll feel proud. So please, if you like this, please subscribe to my channel, and my cell number is 9849238902. Once again I'm telling. Okay, thank you. Thank you all.